Welcome back. Let's get the view of a professional trader now into the world of commodities. So what may lie ahead later this week. Phillip Streible is Chief Market Strategist at Blue Line Futures, and he joins us now. Phillip, why don't we begin where we left off with our previous guest? What's your take on sagging aluminum and copper prices? What is the chief concern of the market here?
Well, first I want to say I love Joe Doe. He's an excellent Bloomberg reporter, and I fully agree with his perspective on the markets here. This copper and aluminum are going to continue to sell off. I mean, they look terrible at the moment here. They're weighing too much in on China. China is going to continue its slowing path here. So we won't see, because of the COVID lockdowns, we won't see any boost whatsoever on those prices.
Okay, why don't we go to other commodities? What is the story on gold, which, despite the huge equity sell-off, is not getting a lift, and despite big escalation in inflation expectations? The U.S. dollar is rising, of course. Is that the big headwind for gold?
Gold looked really good on Friday. It looked like it was breaking out to the upside. The problem that gold had was that you went into this volatility bucket with U.S. equities where basically everything gets thrown out. There's panic selling when we came in this morning. Gold also faces a stronger U.S. dollar, stronger treasury yields. Treasury yields always try and fight for position in gold. I think gold could get its boost and could find its floor once the crypto people finally realize that, you know, Bitcoin and Ethereum are nothing more than just thin air, and it's not a real safe haven asset. What they need to do is transition to a hard metal like gold and silver, which actually have industrial uses and application uses. Bitcoin will never be established as some kind of central currency whatsoever. It just doesn't have the infrastructure for it.
Interesting thoughts there on crypto. What are your thoughts on where this sell-off is going in crypto? Very briefly, we'll move on to some commodities after that.
I think Bitcoin's going to go to zero. So that's basically it. Same thing with Ethereum. Just take a long enough timeline to do it.
Okay, other commodities, oil. Despite the big sell-off we're seeing elsewhere in the commodities world, oil is holding firm. It's almost at 120 US. Can these high levels of oil prices last? We're actually seeing oil right now on our screens at up 25 cents on the session to almost 121.
It's really unfortunate because the Fed needs oil to come down. It needs food and energy prices to come down, and that's how it can create the soft landing. It can raise into a declining inflationary environment, and people have real wages will go up because of the fact that they have to spend less at the pump. So it's discouraging when you see oil prices shoot back up like this, but it's understandable. People are buying any kind of dip. The upward trend's been intact on oil. So, you know, and you've got Biden out lobbying to try and get more oil put up on the, you know, out in the market. But I just don't see how you can ask for more oil, but yet be critical of, you know, oil refineries and things like that.
What equity market investors are hoping for, of course, is the much vaunted soft landing, where the Fed gets inflation under control. The U.S. economy does not contract for 2 consecutive quarters, meeting the definition of a recession. What happens to the commodities world in that scenario?
If you get the soft landing, commodity prices across the board should all come off significantly. So that's what they're hoping for. The problem that we might have is if the Fed remains hawkish, the economy deteriorates, inflation does not back off, because the Federal Reserve cannot control the price of crude oil or the price of, you know, the weather patterns affecting grains and livestock and things like that. They just can't do it. So the only thing they can affect is borrowing costs. They could slow down the housing market significantly. They can crimp consumer credit and consumer spending, and hopefully that'll bring down inflation. But you almost need perfect, you know, weather and things like that in order for a lot of these commodities to come down.
So in a soft landing, you say commodity prices come off. They decline further from their peaks?
Yeah, they decline. The soft landing, they decline. So if all of a sudden, if gasoline or, you know, you go to the gas station, it doesn't cost $100 anymore to fill up your car. It only costs $50. Well, now you've increased your income. You have $50 extra disposable income. Restaurant costs start coming down. Labor costs start coming down. Things like that. That's how you have your disposable income goes up. So you got rising disposable income, declining inflation. You could go out and you could support the economy in other areas where you see value. That's a soft landing right there. That's what the Fed's hoping for.
Okay, what about lumber? One we haven't touched on. It has been, as many viewers know, it's taken a real wild ride through the course of the pandemic, soaring to record high levels, cratering. If we can do a 5-year, we'll see a 5-year view of that. We'll get a better picture of the peaks and valleys over the past couple of years in the lumber market. What's happening now to U.S. home building activity and therefore the price of lumber? Go ahead.
It is definitely a deflationary environment in lumber. I mean, lumber prices have been cut in half, if not even more. The problem is that, you know, you have still supply chain disruptions, which are causing limited amount of lumber in areas where you want to go get it. If you want to go to Home Depot or lumber or Lowe's, it's going to be a bit tighter with lumber what's there. So they're going to remain those prices elevated, and they're trying to, you know, squeeze on their own profit lines. But I think as the Fed raises rates, you continue to see lumber come down because that housing demand is eventually going to get killed. It's just the lack of supply right now is the big issue. So once you get the housing market resupplied, then you're going to see, and that'll happen because of those increased borrowing costs, then you're going to see the price of everything come down.
What about natural gas? Very, very, very volatile, but also trading at very high levels. New York traded current contract natural gas now trading for almost $9 per million BTU.
Way too volatile for the average investor to trade right now. The natural gas, I mean, those price swings on here on a large contract, we moved about 60 cents today. That's a $6,000 move per contract. They do have a smaller one that's a bit more appropriate, but I'm really skeptical. Once you get that level of volatility in there, it's just not worth going in there. You know, a trader likes to do this. They like to remove volatility in their account, take that out, and try and position yourself into things that are moving, that are in the right economic cycle and the right business cycle, and that's how you stay in and you trade in those directions. So natural gas is most likely not an appropriate contract for most people out there. Okay.